You stop playing that.
Oh.
It's okay.
I need to find it.
Yeah. Okay.
Just imagine it.
What did you find? What was the most funny thing you experienced this week?
Funny?
Yeah, what made you laugh hard?
There's something really funny. Wow, I'm blanking. This week has flown by.
This was the shortest week.
I feel like everything.
And I feel like it's just been a blur. Like it's moved so fast. Yeah. But
I don't even. I'm gonna have to think about it. What about you?
What comes to mind is when he shared the clip about where we laugh about the Baba.
Yeah, you actually watched it.
Yeah, I watched it. I think today morning or something. It was probably
yet.
Yesterday. You sent it yesterday, right?
You sent it late at night. You must have been up late.
Then it's probably one of the first things I saw when I woke up. And then I watched it.
So you were laughing and Eva
I
was
found
there
it funny.
sleeping.
No, we listened to it together. She said that's actually funny.
She laughed, right?
Yeah, she said that was funny. So
I don't think she's an easy person to make laugh. I don't think she just laughs for her.
Yeah, she does.
So
oh, there are people laugh for
she
her.
doesn't strike me as a person who just laughs at anything.
Yeah.
I'm good. I'm glad that she found
So
that
I
humorous.
equally found the story funny. When you were mentioning about how you were working hard to, keep the strings connected, the beard strings. That was funny. Hello and welcome to the Full Scale Podcast. I'm your host, Timothy Mukiti, and I'm joined by my friend and colleague here, co-host, Adrian Twatwa. Some of the feedback you guys have given us has been very helpful, and we're hoping to do much better as we go, as we build and we grow and make sure we are providing our audience with not only good content, but we're also equally delivering it very well.
Yeah.
Okay, so today's discussion will be talking about the funding cycles of a startup, the journey about the funding, how they raise money, and how the money, the capital that they raise enables them to scale up, the going full scale for the startups. So Adrian, maybe to get us started, you can tell us a little bit more about, the stages, the typical stages of funding for a startup.
Sure thing. So I guess I'll just preface this by saying this is funding and fundraising part 1, right? So we'll have part 2 episode. So there's going to be quite a bit of content for today. So we thought maybe we'll break it up into 2 episodes. So today we'll go through the stages of fundraising, and then episode 2 we'll do a bit more of a deep dive on some of the instruments that you would use to actually get that fundraising or get that funding into your company or your startup. So to your question, going through the different stages of fundraising for a startup, maybe just to recap what we discussed an episode or 2 ago, the different stages of a startup. You go from your idea stage or concept to producing your MVP, your minimum viable product. You then start to scale that. You go through your growth stage, you expand, you get into all these different markets, and hopefully at the end of it all, you exit through either an IPO or selling to a trade buyer or a strategic player in the market or to a private equity fund. So using that as a framework, we can maybe then work through what type of funding would you expect at the different stages of that journey, right? So let's start from the beginning. So you have your first idea. I'm going to go back to our fitness app.
Yeah.
Because I love this idea.
We need to develop a fitness app, actually.
Honestly, I think we might at the end of this all. So anyway, So you start out, you have your great idea.
Mm-hmm.
The biggest, best idea you've ever had for a fitness app that's going to change the way people work out and just have health as top of mind in Africa or East Africa or whatever. So you have this idea, you quit your day job. You say, I'm going to go all in on this thing. You first start by bootstrapping. Generally speaking, that's what most people start with. So you go take all your savings or however much money out of your savings as you think you need for this venture. You put it into the company. So bootstrapping in that you're pulling yourself up by your bootstraps, right? You're doing this all on your own. You've saved up money and you've decided now is the time to go into this thing. Typically, I think we said most founders are not doing a side job, right? Because it takes a lot of focus, right? And I think
it's extremely, I think statistics show and the founding journey really, when you're running a startup, is very intense, such that it makes it very difficult for a lot of people to do that alongside, another job.
Yeah.
You might not be sleeping if you choose that path.
Even with just the one startup,
itself,
you're probably not sleeping,
you're
right? A
probably
lot
not
of
sleeping,
early work.
Yeah.
And I think we mentioned in a previous episode as well, what you focus on is what gets done. So you focus on this thing, you have your idea, you bootstrap, you put all your money into it, and then you get to a point where you're saying, okay, now maybe I have the concept down and I want to now create that minimum viable product, that MVP, and take that into the market and start testing it. But I've blown through my savings. I now need more money to get into this next level. So who do I go to and what's that next level of funding? So that's now where we get to our, what we call pre-seed stage of funding, right? The people you're targeting for this is we always talk about it. We laugh about this FFF, right?
Yeah.
Family, friends, and fools.
Yes.
Did you want to walk through those three Fs?
Well, the reason I'm laughing is because I read somewhere somebody was trying to be politically correct, not to use the term fools. And they were saying alternative sources that are closely known to the founder. But yeah, happy to work. But it's funding from friends, family, and fools, because at that stage your idea is at very nascent stages. It's very young. You probably have a very good understanding of where you want to get.
Yeah.
But there is no proven track record.
Yeah, there's no product.
There's
even,
no
right?
product even. You haven't even developed a product. It's like we mentioned with our, I think we'll just be using this example of a fitness app, that we could just go to some friends of ours and tell them, we're going to start, you're going to set up a company that deals with a fitness app. We tell them what we think we will achieve, but there's no product. There's nothing. We cannot show them an interface. We cannot show them anything.
Yeah.
So they're probably going to trust us and provide us with funding. Yeah. Simply because they were friends.
Yeah.
They think, okay, fine, I've known these guys for a couple of time. They look like they're decent people. And, we've done other things with them that have seemed to work, or we're fun people together. Yeah. So we'll give them some funding. Family, of course, obligated to fund you, because they're not obligated really, but they'll be more than happy to fund you because they like to support you. And then we have the other category that is fools.
And I think just to highlight on that I guess it's not fools because they're not smart or whatever, but it's fools in the sense that there's no product, there's no traction, there's no proof of value, there's nothing going on at the moment to suggest that this is going to be a success. And as we mentioned, most startups fail at that, very early on will fail. So to take that leap, you either have to have real conviction in this person. So your family, your Dominic Toretto's, your friends, your Timothy Mukitis, or someone who just says, maybe you just have money.
They
and I
have
don't
a lot
mind
to
taking
spare.
a risk.
And there are not many people in this world, who have a lot to spare.
So you're not fools if you're investing in pre-seed. Yeah. We just to caveat
it's just a term really that is used, because ideally it's considered to be high risk investment.
Correct.
And
very
at that
high
stage,
risk.
Generally early stage funding for startups is considered high risk.
Correct.
High risk, high return if it picks up. But even the high risk that I think, as we mentioned in our previous episode, even the risk needs to be measured. It's high risk, but then it's not blind high risk.
Correct.
So at that stage, the level of blindness is extremely high. You
have no revenue, no customers yet, no product.
You haven't
do you want to talk about maybe how much would you expect to raise perhaps in a pre-seed round? Just of course, knowing that this varies widely, like even bootstrapping, you could bootstrap forever, right? You might be really wealthy and you can afford to start this whole thing on your own and do it all the way up to till the point where you exit, right? You might have that much money, but let's assume you don't. Let's assume you had, let's say, $5,000, $10,000, $1 million Kenya shillings for your bootstrapping. And now you've gone through that. Let's say now you're getting to a pre-seed round. Roughly what numbers would you expect?
Actually, before even we address the numbers that we're likely to expect, you and I have met someone who has bootstrapped to the level that they are already at revenue. They are already revenue positive. They have a product that they're selling. They put it out in the market, and they're fundraising. They're trying to do a fundraising now when they're already past the stage where, when they mention that they are fundraising and they mention their product, it's a well-known product.
Yeah.
So I was surprised. Is this your first fundraising that you're doing? They're like, yeah, we're fundraising for the first time. That was impressive, really. The fact that you developed your concept, you've gone to the market, it's amazing. Now, onto the figures. Surprisingly, is that in the US, in America, really, people tend to fundraise way more compared to other locations at every stage. The average ticket size of pre-seed or seed in the US is actually about 2 times as high as the amount that you raise in Europe.
Got you. Okay.
And then you trickle down to Africa, it becomes almost perhaps a third, if you're doing very well, of what people at that particular stage are fundraising in the US.
Got you.
And some of the numbers for, free pre-seed fundraising, and this is mostly, would range between US dollars 10,000 to 100,000.
This varies, right? It could be, you could end up having a pre-seed round where you're raising less than $10,000, or you could be having a pre-seed round where you're raising more than 100K. But the point being, you're not looking for so much money. I've never seen a pre-seed round where someone's raising like $2-3 million. Like at that point, if you're raising 3 million or nothing, you have to be, probably these AI companies are doing that now, but it's not something you'd see so often in the market. So if you are out there, you're starting your business, you have this startup idea, you're getting to that point where you now need that pre-seed money. That's around the range what you should expect. I think $10,000 to $100,000 is spot on. Okay, so that's your pre-seed round. We've talked about the people you can expect to receive that money from, the sort of general amounts. Now you get to your seed round. Okay, so you've built your MVP. It's ready. You've tested it internally. You've tested it externally. And now you're starting to really validate your market demand for that thing. Like, let's go out into the market with this fitness app and let's go to the gyms. Let's go sign up our friends, our family, everyone who we know that's interested in this, and start trying to get that traction. I think that's around when you'd go to get your seed round of funding. So seed in the sense that you're planting a seed in the ground, right? And the hope is it's going to grow into a huge, amazing tree that gives us so many returns in the way of amazing fruit. Seed round, do you want to talk numbers in terms of specifically within the continent? How much are people thinking? Deal value, deal volume, stuff like that.
Within the African continent, I think
you can talk US numbers as well, or like just to give broader context.
Well, but there's a report that was prepared last year by AVCA.
Okay.
Yeah, which puts the number at about, and I'll have to check my data. The median seed size for 2023 in Africa was about 1.2 million US dollars.
Okay.
That was the average.
Okay.
And
so significantly higher than the 100,000 we talked about for
that's
pre-seed,
significantly.
right?
And the thing why it's significant is because at that stage you have a product.
Yeah.
You can actually sell something to somebody. It may not be perfect, but you do actually have a product that you've tested. So at that stage you're trying to get a bit of market traction. You go put it out in the market and you'll make a bit of money. You may not break even at that stage, but you will have made a bit of money, and then that inspires investors to put a bit of money in you. So of course the amount of money that is invested at that stage grows. Yeah. Do you want to tell us a bit about what most VC investments in Africa the last year looked like?
Yeah, I think that you raise a really good point in terms of the median is about 1.2 million, but I think also important to flag that most, like, so you talked about in the US, Europe, the numbers are way bigger. I think that's also, I mean, there are many factors, but also access to funding is a lot more. Funding is a lot more accessible in those markets, right? You can sort of throw a stone and someone's willing to invest in this thing, and you can pitch and you can get a lot of traction. It's a lot harder on the continent. And also a lot of companies are still in that earlier stage, right? A lot of companies don't get to that point where you're now a unicorn, right? You're now Jumia. You've now gone all the way to now we can even IPO you in foreign markets and all of this. A lot of companies sort of die on the vine before they get there. So what you end up seeing in the continent is a lot more VC funding ends up being in the seed, pre-seed stage. So based on that same report from AVCA, most VC deals in Africa, like 37% of VC deals last year were at the seed, pre-seed stage. Also, most of those deals were for 5 million or less. So that's about 45% of them were for 5 million or less. So most of the ticket sizes on the continent are smaller compared to other jurisdictions. And also they're mostly in this early stage. And I think also it speaks to the promise, right? The potential. Most of what we're seeing is that potential. We haven't yet really seen as many of the success stories as we'd like. We'd love to have 10 Ubers on the continent, right? We'd love to have 10 Airbnbs where you've gone from validation all the way to exit. And now people are just, this is a publicly owned company and people are just feasting on dividends and all this, right? That's where we want to get to. But just to sort of frame that's sort of where we are for now. So after your seed stage, you get to post-seed, which I don't even want to spend too much time on this because post-seed is like an awkward stage between where you are and where you want to get to. So in the sense that you've raised your seed round, you're out there, you're getting traction, but you're not yet at the Series A level.
Yes.
Right? And which we're going to get to.
And you need capital.
So exactly, but you still need some money just to get there. So I've heard this described in different ways. So I've seen post-seed where they say, okay, we're not yet Series A, but we need like one last round of funding. Or I've seen where they say the seed Series 1, seed Series 2, or like there's ways people try and break things up.
You know, the strange thing is that I think we're going to even start seeing a lot more breakdowns of this series because the naming of the series, the levels of funding is mostly dependent on what you're going to do with the money.
Yeah.
As opposed to how much money you're raising. Actually, I think we should point that out. It's based on what the money is meant to do. So at seed stage already, you've developed a product that you can actually sell. You can tell people this is what I'm selling. You can buy, but you need to improve a lot more on it. You need to take care of operating expenses, and you need to invest a lot more on R&D, research and development.
Yeah.
So you'll be given money for that stage. But then when you go to series stage funding, and when we go to series A, B, C, D, and you can take the series going, at that stage you're looking for growth.
Correct.
The concept is now clear. What you're doing, you've done you cannot say that you've done enough research, but you've done enough to be sure of what the product you're going to take. So because the categorization is based on what you want to achieve with the funding, then you find sometimes there are splits.
Yeah.
Because you've raised seed, but you're not yet out of seed to go to Series A. So you need to do some more.
Just to get a little farther down the line.
At least further down the line. So you'll move to post-seed. And even then, you might need to raise again before you get to Series A.
Yeah.
So you might have to split it to post-seed A1 or post-seed 2, post-seed 3. And I think as we progress, we are probably going to see a lot more. And I think it's still happening where there's a bit of splitting, you know,
within those rounds.
Yeah, within those rounds, because I mean, the funding cycles are dynamic. They evolve as the business progresses, as it grows. And building a startup is very cash intensive.
Yeah.
Or you need a lot of funding. So sometimes, the idea is to try not to run out of cash as soon as possible.
Yeah. And we'll talk about how long a runway you should expect for, how long should you go before you fundraise again, right? How long should that money last?
Exactly. So the idea is not to run out of capital as soon as possible, but to try and keep it going. But still, even as you try to keep it going, it's not cast in stone that you will raise series seed funding, and then it will be enough to take you all the way to Series A.
Yeah.
You might raise it and you may realize that you're close to running out of capital.
And
then
you start to raise again.
Yeah.
Or you might find that, wow, we're actually way ahead of where we expected. We can now skip to like a series.
Exactly.
Right? From pre-seed all the way to Series A or something like that. So I think what we're giving is a general framework of how it usually goes, but each case is independent and everything is sort of different from your perspective and what's happening in your startup. So again, talk to your legal advisors, talk to your financial advisors. Yes. This is not legal advice. So
we need to have that caveat going there.
Talk to the professionals that have done this before in the region where you're trying to do it, and get the advice that you need for your specific situation. But these are general principles.
Yes.
So you've gone through your post-seed, you're now at Series A. So Series A, as we discussed now, you've found your product market fit. You know that you can capture a decent share of the market, right? Like we know this fitness app is going to blow up, and Kenya and East Africa and everyone's going to love it. And we know for a fact that we're going to succeed. So let's do Series A. Let's get as much funding in as possible. So now we can scale this thing. Let's open an office in, in Johannesburg. Let's open an office in Cairo. Let's hire staff. Let's get a solid team going. And let's just mass produce this thing and scale. That's about where I think a Series A is coming in. And in terms of numbers, do you want to talk about numbers? Because so Series A is essentially, you're at that point. Series B, you're a little further down the line, right? Series C, and so on and so forth. It's basically extrapolating the same thing over time. So you're expanding year one, maybe you raise your Series A. Then let's say year 3, you're about to run out of that cash from year 1. Let's now do a Series B and Series C and Series D and so on until we get to exit, which we will talk about next. But do you want to talk about numbers that people should expect around that point? Because I think we talked about what you'd expect at seed. So maybe Series A.
Well, the median size of from the Africa report for 2023, the median size of the capital invested in Series A across the African continent was about $7 million.
Got you.
So of course it moves higher and lower, but that's the size, the amount of money you're sort of looking for that stage, about $7 million.
Okay, and that's just a median, right? There's outliers on either side.
Definitely outliers. Outliers. And speaking of outliers, even to take us back when we were speaking about raising money for seed or pre-seed, sometimes it's possible to raise a lot of money at that stage, especially if you are a founder who has successfully founded a startup that grew and exited either through an IPO or was sold through a trade buy or by a strategic buyer, and now you're setting up another startup. There's a lot of faith in you as a founder that you're capable of seeing something through. And therefore, you're actually capable of raising significant money. You can actually raise as much as some people would be raising at Series A, or already at pre-seed or seed.
Do you have any examples of folks that you've seen, even if you've not seen them do it, but there's such conviction around a founder that, wow, this person did that. Now that they're raising again, I'm ready to put so much money in them before I even see a product.
There is one actually I know, but then I don't want to mention the founder's name because I don't have the approval to mention on this. But we can have a chat on the side chat.
Okay,
and maybe,
they might get even more funding
in future. Where they can be our guests and they can tell us how they're able to turn around one startup. And
so if you're watching, mystery founder, hey, we could throw some more money your way. We are watching you. The one I was gonna maybe talk about. Of course, now like Elon Musk. Of course, maybe he doesn't really need to raise and he can bootstrap something all the way. But if Elon Musk comes out tomorrow and says, I'm starting a new venture, and, okay, let's think about Elon Musk many years ago, after the success of like PayPal and things that he was early on, he starts Tesla, right? He says, this is what I'm doing. Guys, I'm starting a seed round. Someone like that, who you've seen do something that was hugely successful. That whole, like, all the guys who were who initially founded PayPal, the guys who founded like OpenAI, things like that, right? When they go off to do something else, people look at them and they say, you know what? Success seems to follow this person around. So I'm going to bet on this person. Again, going to the importance of founders, and people bet on people, not on ideas so much. Yeah. Okay.
Well, trust me, even myself, if I had money and Elon Musk is starting something, I do not necessarily need to understand what it means. For another friend that is seeking funding, I might need to have a discussion. We sit down, explain this concept to me.
Yeah.
But if it's Elon Musk, I don't need to know. I have a sense that he will make it work. Yeah.
That is not best practice. Just so you know.
Best practice, of course.
But do your due diligence just in case. But definitely. But just to speak to that point.
Yeah, due diligence is your friend throughout the funding series.
That's going to be a whole thing.
It's your friend through and through. Yeah.
So I think we've talked about a median 7 million last year. Yeah. What about Series B and
in
C
Africa,
maybe?
Across the continent,
in Africa.
Yeah.
What about Series B and C? How much did we see? Do we have median numbers for that?
Was about for Series B was about $20 million. Okay,
so from 7 to 20.
Yeah, so
you can see a huge jump, right?
Million, exactly. And the thing is, for Series, you're looking for growth. Every round you're raising for Series is growth capital. You're really looking towards expanding. You're looking at scaling up.
Yeah.
So and with every successful round of fundraising, either Series A or B, it attracts more people, and of course a lot of investors, because a lot of investors would want to come to invest in a concept that other investors seem to have faith in, because that helps you.
Yeah.
In fact, if you successfully raise seed capital, then you start and you utilize it well, because you could raise seed capital and burn it for nothing.
True.
But if you raise seed capital and you utilize it well, you attract better chance to raise Series A. If you raise Series A and your traction is good and you're making good progress, you're likely to raise more in Series B.
Yeah.
And it follows and it follows. So it's more or less like being a faithful custodian of because you have the idea, but then you seem to be a faithful custodian of investors' money. And
on that, sorry, I didn't mean to cut you off.
No, it's okay.
You've raised a good point, which reminds me, if you raise Series A, and I see, so let's say I'm coming in for Series B, but I come in for Series B, and none of your Series A investors are reinvesting in Series B. Yeah, that might be a cause for concern. Not necessarily, but it's a bit of a concern, because the thinking being, if you got guys to invest in your Series A, $7 million, and they see real promise, the odds are they would come in again for a little bit to follow on that investment, sort of a follow-on investment, investing again in something you already invested in.
Exactly.
You would expect them to come in for a Series B, Series C, maybe not all the series, but you'd expect them to maybe top up a little bit. Even from their perspective, as an investor who came in Series A, I want more people to be coming in down the line in Series B and saying, the valuation of the company to grow and all of this. So even for me as an investor in Series A, I might just want to put a little bit of money in Series B just to show that I have this much faith in this business that others should also be coming in, right? So there's so many dynamics there. When you come in Series B, you also look at the people who came in Series A and you think they did due diligence, right? So if they're really big investors and you really trust their opinion, you can say, wow, those guys did a DD on this company and they thought it was worth investing in. So there's a lot that who your investors are, whether they come in again, your relationship with them. It's so interesting. And there's a lot that goes into that, and that could lead to more success down the line, or could inhibit your success if they don't come in again.
Exactly. It could inhibit your success, because your interests are tied with the institutions or the funders, that the VC or funds that provided you funding at Series A.
True.
Your fate is sort of tied to them.
Correct.
So they want you to succeed.
Yeah.
Because when you succeed, they succeed as well. So they would want to even make your sort of be partners towards raising Series B. Now, if they are holding back, then it has to be serious. If they're holding back when you're going to Series B and Series C, then you're starting to wonder whether there's something that is not exactly where it should be. Yeah. So those are some of the concerns. Yeah.
I think that's where we said 20 million median size for Series B. Series C, do you want to give us a number for that?
For 2023, from the AFCA report, the median was about 46 million.
Wow. So we've said
dollars,
like, let's say
US dollars.
Let's say we've said from pre-seed, you're looking at, let's say, about maximum around $100,000, of course, generally, to then about 1.2 million at seed, to 7 million at Series A, 20 million Series B, 46 million Series C. So you can see you're getting a lot more money as you go down the line, but also that's a lot of money. So you need to make sure you know what to use it for, and that you're really dedicating it to growing the company, right?
Yes. You indeed need to know what you're using the money for. And again, it's got to reflect that at this stage, your concept is much more tried and tested. Yeah. It's a question of expansion and growth, and making, improving the value of your investments for the investors and the founders as well.
But it also shows the value of coming in early, right? Because if I came in early and I gave you $100,000 at a pre-seed stage, and now you're raising 46 million on a Series C, the valuation has grown so much by then. I can only imagine. So my 100,000 is going to be worth a lot of money by then. So I think, plug for African startups that are really trying at the seed and pre-seed stage. Those are the bets really worth making. I mean, you can come in at Series C, but I mean, your 100,000 of a 46 million raise is worth so much less than if you were one or two people raising $100,000 for this company at pre-seed stage. So anyway, more on that later. So what about, so I think we've sort of talked about all the way through series. Let's talk exit, because this is like the biggest, it's not the biggest, but it's a huge milestone. And for many startup founders, it's the goal, which we've spoken about. Some people don't really want to ever exit, but many startup founders want to exit. Like that's the goal is I want to build this company, make it amazing, and I want to sell and retire with millions of dollars, right?
Yeah, and even the investors at the early stage want also to exit so that they can recoup their investment.
Right. So it's what gives your investors their out, right? This is why they're investing so that they can exit one day. So ways to exit. We talked about IPO in a previous episode. So you do your public offering, you list and you sell on public exchanges or stock exchanges. For many, we've discussed a few reasons why this is not always feasible on the continent. Sort of a lot of the stock exchanges are pretty nascent. They're not as strong and robust as you would find in other jurisdictions. They're not as liquid. There are not as many companies listed.
Actually, can I provide you with interesting statistics? I was looking
at, I love statistics.
The value of trading and how much trading is done at the Nairobi Securities Exchange.
Okay.
Surprise, 80% of the trading done on a daily basis is done by foreigners.
Yeah, foreign investors.
Foreign investors are the one who are actually doing a lot of active trading.
And which is why when there's political issues, you see that the stock exchange
sort of plateaus a bit. And,
or even plummets because a lot of the foreign investors are getting skittish and they're saying, whoa, I don't know what's going on in this country. Let me go invest elsewhere.
And you know, of course I know the Capital Markets Authority has been doing a lot of work in terms of building awareness in the country and trying to see how best to build activity for the stock market securities exchange in Nairobi.
Yeah.
But sometimes I wonder, maybe is it that the market generally considered this as a very sophisticated area of investment, or because those numbers are sort of alarming, you know, for a country that has a lot of high net worth individuals.
Yeah.
Again, also going to the concept of fundraising for startups. For a country that has a lot of high net worth individuals, then we should perhaps see a lot more involvement of such high net worth individuals
in the stock market.
In the stock market.
Yeah.
And perhaps also investing in the startups.
Yeah.
Because
100%.
Yeah, at the early stages.
Yes.
Because if you invest in a startup at the early stages, most of the funding that is raised in this series, most of it is actually foreign capital.
Yeah, again,
it's not the capital that is raised for most of the investors that are investing in startups in Africa. By and large, significant portion of it is foreign capital.
Yeah.
So yeah.
I think it's a really cool topic and it's something that we would need to sit down and explore. I'd love for our viewers and listeners to chime in with what their thoughts are on why is it that most of the capital coming in to invest in the stock markets, in VC rounds, PE rounds, all of this is foreign capital. I mean, I have my theories. None of this is backed by data. So this is just my thinking. I think there's this view that I invest in what I know, and what I know is real estate, is land. I know this land that I'm going to buy is going to constantly appreciate, and nothing's going to change that.
Build a block of apartments and you know you have rent going.
I know people are building apartments. I know I can put my money into that thing and I'll do this and that. Those are the sort of things that people understand and that they've seen and they're tried and tested to some degree. I think there's also just, and then there's also the thought that if I'm not doing it in land, I'll do bonds, government bonds, safer bets. So we've had discussions about this where I'm like, why aren't pension funds in Kenya, for example, investing a lot more in private equity, right? Because you see in the US, in other jurisdictions, when you look at the list of LPs, the list of investors in a private equity fund, you'll find like maybe 50% of them are pension funds. Pension, like firefighters, pension fund, pension fund for school teachers, It's a risky asset class, of course. So, there's of course that risk that you're going to lose people's hard-earned retirement money. But there's also the recognition that what else are you investing in? Are you going to put all that money in bonds and real estate and other quote unquote safer investments? I think there needs to be some sort of risk analysis and say, okay, the majority of the portfolio should be safer, but then some of that should go into riskier assets, which could get us a better bet.
Yeah, but I totally agree with what you're saying, and some of them also are concerns around it's regulatory concerns.
Yeah, exactly.
There are limits to how much you can
True.
invest if you're a pension fund. Pension funds are regulated locally under the local law.
Yep.
So some of these limitations are regulatory, but there's been good traction. There's been good developments. I know some especially funds.
Yeah.
Some of them have raised significant capital.
The PE funds.
PE funds, especially, at that stage, compared to periods before from pension funds.
Correct.
So
I think the trend is going in the right way.
The trend is going in the right direction. Yeah.
Only other thing I think I'd flag is on stock exchanges. Also, I think there's not enough variety yet because it's really tough to IPO. It's a regulatory intensive activity for you to decide to list your company. There's a lot that goes into it. So there are not that many companies on the stock exchange.
Hopefully it will grow and become an avenue of exit options.
Yeah.
For for Kenya and the African market.
Yeah.
Because it's really where you start to see a lot of faith in your concept. If people are buying and a lot of and your value that is measured in terms of your stock holding in this particular company. Hopefully we'll see a bit of growth. And speaking of IPO, I mean, there are a couple of other exit options, which are more popular now in the African continent.
Sure.
You want to mention a bit
about
that? Yeah.
So IPO we've mentioned. Yeah. We've spent quite a bit of time on that, but I think it was a worthwhile discussion.
Yeah.
I think the more popular routes are usually you sell to a trade buyer or a strategic player in your same market. So we have built the amazing fitness app. I mean, I don't know who else is in the fitness app business, but let's say there's a huge competitor or a huge...
It's coming. We're going to be serious competitors in the market. Fitness.
Fitness with Tim and
Adrian.
Or there's like an established brick and mortar brand that's been doing this. Like, let's say the equipment brands, the ones who provide the equipment for fitness gyms and such. Maybe they then say, you know what, let's buy this fitness app because then it's an add-on for all the other things that we're already doing or whatever. It makes sense for them. You find someone else in your market who, if they had your business, they would do so much better, right? They would synergize it. They would build it into whatever they're doing already and just go off and take it to a whole other level. So you'd sell to a trade buyer or strategic buyer, or you could sell to a private equity fund, which is also a pretty popular route on the continent in that. And we'll talk more about PE funds and sort of what their model is. But PE fund sees you and they say, this business has a lot of potential. It's grown so much, but there's more growth that they could do. And we see more runway here. So let's buy this company. Let's turn it around, flip it in the sense that, like flipping a house, like you find a dilapidated house or some house that you don't think is in good condition. You renovate it, you board up, you fix the windows, you improve it in so many ways, and then you resell it. Pretty much what private equity funds do. And so they could buy that company from you. You could stay on as a sort of manager or executive in the company for a few years or something like that. Usually that's a lot of the times how it happens, just for continuity. But then they turn the company around and then they sell it eventually to maybe another private equity fund or another trade buyer or IPO or something like that. Those are the routes that I've typically seen on the continent. You want to add to that?
Actually, I mean, there's not more to add. It's literally the exit options, and in the continent, the exit through an IPOs has not been very very active.
Yeah,
but we have more of exits through trade buyers or strategic buyers or even a private equity fund.
Correct.
And on that point about a private equity fund, we've talked about venture capital funds and private equity funds. Do you mind letting our audience know what exactly is the difference between a venture capital fund and a private equity fund?
Sure. In
terms of structure and how they operate, and where you're looking, if you're a founder and you're running a business, where you're looking to raise capital from? Who are you who would you approach at what stage?
Okay, I think that's a great question.
Yeah.
So I think we've talked about some of the other types of investors. We've talked about family, friends, and alternative people close to the founder. Talked about those. Talked about angel investors, I think, to a certain extent. Angel investors just being people who are, again, coming in early. They have money. They're like your angel that comes out of nowhere and says, here's money to do your thing. Wow. And then...
keep the lights on, do your research.
Family, friends, angels, I don't think their return expectation, I think, is, your family, maybe they're like, we just hope he or she is just continuing to live and do well. But I think
Yeah.
angel investors, maybe they want like a 2x, 3x return. I mean, they want as much as money as possible, but they're more sort of reasonable in what they expect in terms of returns. That's your family, friends, VC, angels, high net worth individuals, that type of folks. Now you get to your PE and VC. So I think you've seen angels and friends and family; those guys come in earlier. VC, I think, from the pre-seed, seed stage, early series A, B, thereabouts, I think that's where VC typically comes in. So the VC venture capital model is venture capital. We are going to venture and see what's out there, and we're going to make bets, and we're going to hope that we win.
Yeah.
The model is, so the structure is similar to a private equity fund, typically, in that it's a partnership where there's a general partner. The general partner has all the sort of, they're in charge of the day-to-day running of the fund, looking for investments, making the investments, deploying the capital, etc. That's the general part. The limited partner are the investors. So there are investors within the VC fund, and the VC fund is also an investor. So just think of it sort of that way. I hope that's not too sort of layered, but it's essentially a vehicle to make investments. The investments make returns. The returns go up to the investors. And of course, the fund manager makes a cut. That's the same structure for VC as it is for PE. So in that sense, they're pretty similar. What the difference is in how they go about their business and what types of bets they're making.
Exactly.
So the VC funds are coming in really early, that pre-seed, seed, early series stage, because they want to make a bet that's so good that it's going to get them like 100x return, 1,000x return, 1,000,000x return, whatever it is, as long as it's astronomical. That's sort of what they're looking at. So to make those types of returns, as we discussed, you have to come in very early. If you come in at IPO stage, you're more, I mean, unless you're like in Nvidia or something like that, you're not expected to 100x over 10 years or something, right? You, that's not really what we expect. We're expecting
you're going for smaller multiples. But then there is certainty, almost certainty that you're likely to meet this. So at venture capital stage, it's high risk, but very high returns.
Correct. And they make many more bets, I would say. So a VC fund may make, let's say in a year, I mean, I'm just hypothesizing here, but let's say 10 investments in a year. Their expectation is that, I mean, their hope is that all of them are winning bets. But the expectation is that, let's say 9 out of those are going to fail. They're not, I mean, based on the numbers, statistics as we mentioned.
Nine are going to fail or 8 are going to fail.
Exactly.
Statistically,
but that 1 or 2 that succeed are going to make so much money that it's going to cover all the 8 bets that failed. And it's going even then some. So that's the model. It's we're going to shoot and we're going to hope we hit a target. Like 1 or 2 targets, and those 2 targets are going to be amazing, and we're going to eat off of that for many years to come. Private equity is different because, again, private equity comes in a little later down the stage. Your company is a bit more mature. There's a lot more traction. So there's less risk. I mean, there's still risk, but it's much less than at the VC stage. So VC, I mean, sometimes there's overlap where VC and PE are both investing, but generally VC is coming in earlier and PE is coming in at the later stages. So PE's model is we're coming in, your business already has traction. As I said, you're going to flip it and just make it even better, and we're going to make returns in that way. They make safer bets. So let's say PE fund makes 3 investments over the course of a year. These are 3 investments that they've spent so much time doing the DD. They've gone to sit with the people who are running the company. They've looked into the books. They do so much analysis before they deploy the capital. I would say a lot more than a VC fund. Because also there's less for a VC fund to look at, right? You're coming in so early. How much DD can we really do on this company when there's not so much there yet? So PE does a lot more DD, but they're only doing 3 bets a year, and they're hoping all 3 of those really turn out, right? They're not doing a thing where they're shooting and they're hoping only one of those hits. Really, all 3 of these need to make a good enough return, but it's going to be a more modest return than the 100, 1,000x returns that are expected from a VC investment.
Indeed.
Does that about cover? Oh, you also asked me, so who are you looking at based on where your company is at? Are you looking at VC money or PE money? I would say, based on what we just discussed, if you're really early on, you don't have traction yet, you're still just testing the market, etc. Your VC is what you're looking at mostly, and which is why most of the investing that ends up happening on the continent is VC investment, because that's where that's the stage at which most of these companies are at. PE companies, you need to be more mature. You need to be farther into your life cycle. A lot of those companies on the continent end up being family owned. They end up being things that have been passed down through generations. So there's a bit of skepticism there to allow a PE investor to come in. Also, this reminds me, PE investors tend to want control, right? To do all the things that we talked about.
You want more control as you invest, because I mean, you're going, and again, to add on what you've mentioned, the amount of money you're investing at PE stage is huge.
Yeah, I should control this thing if I'm putting hundreds of millions.
What you're investing at VC stage.
Yeah.
And therefore you would want, basically because of the size of your investment, you want to have more control.
Correct.
We want to have more eyes on the business and ears on what is happening in the business.
True. And to be able to do those things, to turn the business around, hire new executives. Yeah.
And then again, you see for VC, it's unlike a VC, because a VC you're investing in as many.
Yeah.
So because you're investing in many of them, if you're going to be involved in day-to-day management in all of them, you won't be able to invest anymore.
Exactly. You're not going to have enough time to do anything. I think the only other thing to point out is control may be in the sense of PE fund wants 51% shares in the company, or it could be significant veto rights, right? Like the company can't change direction or take on a new business line or whatever unless I approve or I can veto that.
Exactly.
So it may take different shapes and forms, but the thought process being we want to be able to control the direction in which this company goes. So we've talked about funding and fundraising, the different rounds and sort of where you're at as a company, the different money you can expect, the different types of investors. So as you go through that process, what are some insights that you think folks should be thinking about or should consider? And I'll tee you up with the first one, which is a question for you. Your startup, you have this great fitness app idea.
Yeah.
Should you even raise money? I think a lot of times people think it's a given that, I need to raise money. But should you raise money? Is that something that you should always be doing?
Yes and no.
Okay. It depends.
It depends.
Classic
Actually,
lawyer answer.
It depends.
Okay, let's go.
It depends, because you should raise only as much money as you need.
Okay.
And granted, a lot of startups need a lot of capital.
Okay.
But if for any reason you're able to bootstrap for long and actually get to being revenue positive without getting capital coming in, you stand to reap the reward of taking that risk and going with it until a particular level. You reap all that benefit that comes with it.
And why is that? Just to break it down in terms of, I've bootstrapped and I've gotten to success.
Yeah.
And my company is now valued at $100 million.
Yeah.
And I'm the only shareholder.
Exactly.
Versus someone else who has done the same thing, but they've given away 30% of their company.
Or even sometimes, and fundraising for the early stages, a lot of, you see, the thing is the value concept is not very clear at that stage. What is a value, because you're basing it on the concept that you have and perhaps the future growth.
Yeah.
And sometimes you could sell yourself short. You could literally give too much. So it's not the same as if you've worked hard and you've bootstrapped. If you can, really. If you've bootstrapped and then you're at a stage where you've made a lot of revenue, a lot of money. Yeah. That's your money. But it's different if you're sharing this money at 50, while you, at the point of fundraising, you are doing it not having looked at your needs carefully.
Okay.
You are just having a fantastic concept and you're eager to fundraise.
Yeah.
Because everybody investing at that stage wants to have astronomical returns.
Yeah.
And you're going to have to share them with everyone. Of course, a lot of startups need to fundraise, but then if you don't raise more capital than you need, because still the capital will need to go back to the investors.
Yeah.
It will need to give them returns. But another thing is, when I say yes and no, also fundraising, especially when you bring institutional investors, is good for you in future. Because if there is evidence that you got seed funding from credible VCs, when you're working on your on your startup, it makes it so much easier to raise Series A.
Yeah.
Because it's more or less like a referral system.
Yeah.
Makes it a little easier that, okay, fine. If this VC fund invested in them, I think they probably believed in the concept.
And many of those investors know one another.
Of course.
So it's just a phone call like, hey, you guys deployed in this company. What's that about? Yeah.
Yeah. And they tell them this is a gold mine. You go for it. So yes, and knowing that, I think founders should be careful to not invest to not fundraise when they do not need the capital.
Mm-hmm.
But at the same time, it's good when you need it. Of course, you need to fundraise.
Yep.
But then also there's that belief that comes from the fact that this VC fund invested in you.
Yeah.
If this angel investor who we know does their work has a sense to, generally invest in startups that are going to grow big,
Yeah.
then you're more likely to start having easier rounds going down the line.
Correct.
Yes.
I think those are all great points. The only thing I would add is also the fact that your investors are in many ways your business partners, especially that early on, right?
Mm-hmm.
Someone comes in and they've now bought 10% of this business, 20% of the business very early on. I think something else you should be thinking is, what value are they bringing to this company? Because that's a lot of there's a lot of shares to give away. There's a lot of your ownership to give away, because that could be worth a lot down the line. So you're giving away a lot of value. What are you getting in return? Yes, you're getting money, but money is money, right? Tim could give me $100,000 and Steve could give me $100,000. But if Tim's giving me $100,000 and he's also going to he's going to be an advisor in my company, he's going to make introductions to other VC investors. He's going to find me new hires because he has a network of really cool talent that he can bring to, he has all this additional value he's going to bring to me. Versus Steve is going to give me 100,000 and be like, bro, I need my money soon, right?
Yeah, that's true.
So you need to now consider what type of money are you bringing in, right? So the dollars are the same or the shillings are the same, but what additional value are you getting on top of that?
Is it coming with? That's true.
Correct. Because people have expectations. I think the only thing also to add on that is VC money specifically is coming in expecting 100x, 1000x, big returns.
Big returns, that's true.
Is your company, your startup idea designed to get those returns, right? So as we discussed, the idea of starting a barbershop. So we started a barbershop, we're going to cut hair in, maybe we have a novel way that we think is going to be great, whatever. But it's literally the two of us and we're going to hire people.
In a minute, you save time, yeah?
Right? And it doesn't cut off my sideburns by mistake. So let's say that's a business. Is that a business that's designed to get 100x returns? So should you be accepting money from people who are going to expect those types of returns?
Well,
right?
it's not even whether you should be accepting. It's whether they will be willing to give you that money.
True, but they might not know what they're doing, right? So should you be seeking that type of money from them as well?
No,
right?
not exactly. You need to be careful because it's and by saying you need to be careful, it's both ways. I mean, the investors also do their bit of due diligence. They need to know whether the concept is sound. Yeah. But even you as a founder, you need to be to understand exactly what you need your funds for. What exactly do you need to do? Yeah. If you can cover it with bootstrapping, or you can get a strategic investor who adds more value to you as a business, it's much better. You're using
all the best buzzwords. Strategic investor, right? Someone who can actually help you give you more value for that money.
Exactly.
So two things that come out of that. One is having a clear use of proceeds, right? So when you take money, say you've raised $1 million.
Yep.
Do you know what you're going to use $1 million for? I've never seen what $1 million look like. Like if you put $1 million here on the table and ask me how much is that, I couldn't tell you because I've never seen it.
I might faint because I've seen it on paper, but I've never seen it.
So now that you've received $1 million, do you even know what you're going to use that money for? Right? You need to be very clear. I'm going to hire 3 people. These 3 people are going to do these things. These are their salaries. That money is going to last us this many years. How much is that total? We're going to do R&D. R&D roughly estimate this is how much it costs. We're going to need a new building. This is how much it costs for renting a space or leasing or whatever. Having that really down and clear is so important when you're raising capital because the fundraising process, the investors are going to ask you, what are you using the money for? So I'm going to give you this $1 million, but do you know what to use it for? And can you clearly explain how it's going to be used? Exactly. I think that's a very important one.
Yeah.
And also to the point of making 100x, 200x returns. The point I wanted to flag there is that.
And when we say 100x, 200x, it's times. So if you're making, I mean, sometimes you also try to make sure our audience understands.
Yeah, of course.
Of course, we know
especially in these introductory episodes.
Exactly. Yeah. So when we say 100x, it's 100 times over. So,
correct. And I think that's sort of the format for now is we're trying to make sure everyone's on the same page and we're introducing these concepts. But down the line, we're just going to say MVP.
MVP.
I'm not going to go back and if you don't go back and watch episode 2, timestamp like 30 minutes in, something like that.
Yeah.
So the point I want to raise here is if you want to build a business that's designed to reach 100x, 200x returns, in this day and age, most of the businesses that are able to achieve that are businesses that are tech enabled or that focus on technology.
Exactly.
Point being, technology is a thing that can supercharge whatever it is that you're doing, right? So creating a podcast today is way easier, I think, than probably what it was 5-10 years ago, because technology is improved. People have done this. So it's something that is able to now disseminate an idea across many, many regions, many platforms as possible in such a quick way. If you're able to use technology in whatever it is that you're doing, you're much more likely to achieve those types of returns. So I think the data bears this out in that 74% of the VC deals last year on the continent were in technology or tech-enabled companies. And this is across different sectors. So
health sector, agriculture,
so
fintech.
I'll say fintech, health tech, ed tech,
health
education tech, ag tech,
tech, yes, education,
agricultural
technology,
tech,
exactly. That's
climate tech.
So you maybe
fit tech.
Maybe if you want to get your startup going, you probably need to have tech somewhere.
We're gonna make the barber tech.
Barber tech.
It is gonna launch.
Or fitness tech.
So having that technology component, I think, is so crucial now if you want to get those supercharged returns.
Agreed.
So I would encourage a lot of people to sort of focus on things that are within that realm. Or hey, maybe you have a different idea that maybe is not tech focused, but if it has potential, odds are if you add technology onto that, it's just going to 100x it, maybe, right?
That's the thing. If you and you see, technology allows you to scale up a lot quicker. Because there's a lot of benefit you get from technology. First of all, automation. Or even ability to do the ability to scale when you're using tech is much easier. If I'm using some technology that helps me with irrigating my farm, it's so much easier to roll out that in many other places. As opposed to if I gather a bunch of 100 people and I organize them very well to help me irrigating the farm. I mean, scaling that up is a little complicated. So of course, leveraging on tech is key. And as data has just shown, especially from last year's investments in the African continent, tech really benefited very much.
Correct.
So I mean, for a founder, you might, whatever idea you have, it probably would help much if you find a way to introduce tech. I mean, even in the legal practice,
legal tech.
There's conversation of legal tech, how that is likely to moving ahead of times, trying to impress tech in terms of helping you do and deliver better work to clients and in a timely manner.
And disrupting what's been happening and creating more efficiencies for clients, more efficiencies for lawyers, I think more importantly, right? Because if you can do the same thing, but in a shorter amount of time, I think you'd probably usually do that every time, right? I think that's it in terms of the substance. Unless there's anything else you wanted to add before we move on to our more fun segments.
Well, not at the moment, but maybe I could ask you, let's have some wisdom from the course. So
my favorite part of
what's
the podcast.
Your latest wisdom from the course?
Okay.
Yeah, what have you learned of late?
So, today's wisdom from the course is it's gonna sound really cliche and really really dumb, but anyway, the real golf was the friends we made along the way. Which is so to put this into context. Think of a story. I mean, it's like a meme at this point, but story being these kids get together and they're off to find some treasure somewhere, right? And the whole point of this journey is to go find the treasure. But along the journey, they find themselves. They find companionship and friendship and all this. And whatever it is, whether they find the treasure or not, the real treasure is the friendships they made along the way, right? So it's very cliche and, whatever, heartwarming. But I think it's so true, especially when it comes to golf. In that golf, so I guess touching on this, the social part of it, right? As a game, you get to meet. We talked about golf being a game where you're playing against yourself, but there are other people that are playing with you in any given round, right? Even at the clubhouse, whatever. There's so many people that you meet. And golf is such a cool sport in that you get to actually talk to people so much while you're doing it. I think if we're playing a 90-minute game of football, me versus my team versus yours, we're not really talking much to you guys as the opponents, right? We'll talk amongst ourselves as a team and it's a team game. But being able to talk to people even as you're competing with them and learning from them, we play with all of like older gentlemen.
Yeah,
We've been playing this game for many years, right?
exactly.
And so we asked
There's
him,
a
like, when
gentleman
did
who
you
told
start?
us that he started playing in 1986. I
Right?
wasn't born.
Me neither. So it's like,
Yeah.
wow, this guy's been playing long. And I mean, he played well enough to justify
Exactly, to
that as well.
justify
Right?
the years.
Hopefully,
Yeah.
when I'm playing 50 years from now, I play well enough that people are like, okay, he
Yeah,
actually did start a
that's
long time
true.
ago.
Yeah.
So meeting new people, I think that's been really cool. Like older folks as well as people our age, which is really always refreshing when we meet people our age who are also playing golf, because that's really cool. I feel like it's often thought of as an older game and all this, but being able to find people who are youthful and also starting out, or they've already been playing this for many years, I think that's really cool. So meeting new friends, keeping in touch with existing friends. I always find golf is a great way for you and I to keep in touch. I mean, before we even started the podcast, we always would play, and it was a great way for us to just spend 4 hours together.
Exactly.
And though every time I'd go home, my wife would be like, "So what's new in Tim's life now that you've been spending 4 hours
and
together?"
And we realized we didn't talk much about what's new other than playing a round of golf.
And I'm like, he has a new driver,
and,
but I don't know what else is new. Really, we just typical men conversations. Anyway, keeping up with friends currently, and then also like reconnecting with people. So a few months ago, I think you and I played with a childhood friend of mine who was in town for like a week or so on vacation, and we played. He used to play golf when we were kids, actually, which I always found so weird. I was like, why is this guy playing golf? Like everyone else wants to go play football and do all these other things, and this guy goes play golf.
Yeah.
Which now that I look back at it,
you should have been playing.
He
golf.
was onto something, right? He knew what he was doing.
Yeah.
So playing with him and reconnecting with him was such a lovely. It was like one of the best days I had that whole month.
Yeah.
Just talking to him, catching up over the time that we only played 9 holes with him as well, right?
Yes.
But
and he's
even
a single
that,
handicapper.
Yeah, he's really good.
Impressive.
So
yeah.
Even just those 9 holes playing with him was really cool.
Yeah.
And just being able to spend time with people, I think that's the general theme, right? You find such cool connections and you make such cool connections on the course that then play out in life. But the lesson being, even in life, right? Finding time to make those connections, even if it's not on a golf course, right? Finding time to connect with people, sit down, reconnect with old friends, stay in touch with current friends, and make new friends. I think just the social aspect of life is so important as social beings. I think it's just so key for us as human beings. So that's sort of the wisdom that I got from the course. It's that, and I'm glad that the course helps me do that, because I as you know this, my favorite place to be is at home.
Yeah.
Like I want to be at home
it's really
most
hard
of the
to
time.
get you out of the house. Unless they're playing Afrobeats somewhere. You can get out of the house if anybody's playing Afrobeats. Yeah.
So I love that the golf course gets me out of my comfort zone, takes me to a new place. I meet new people. I reconnect with folks. But I'm also trying to be more intentional about doing that even outside of the golf course, right? So meeting up with people, reconnecting with friends, checking in, that type of thing. So if I haven't checked in with you in a while, I'm sorry. I'm trying to be better. And golf is helping me to do that. So yeah, so the real golf was the friends we made along the way. Friendship. I don't know if you've seen that SpongeBob meme, but yeah. So anyway.
Absolutely beautiful wisdom from the course. And actually, perhaps to add on that is that you become better friends with somebody when you share a struggle.
Yeah, right? And
golf is tough.
Oh, yeah.
Golf will teach you a few things every day. It humbles you every time you hit the course. It doesn't like overconfident people.
Nope.
And the fact that you're sharing this struggle, you're getting a bad shot, you're the person next playing with you in your flight also getting a terrible shot, missing some simple parts.
Yeah.
It's somehow you have a struggle that you're doing together, and somehow that builds familiarity. You become better friends as you do it. Yeah, wonderful. That's thank you for those insights. So I guess we will wrap it up for our audience.
No, you got to tell us what you found interesting this week.
Yes. Well, okay.
Yeah.
Thank you for that. I had forgotten. Apologies.
No worries.
What I found interesting was founders that get kicked out of companies they founded.
Okay. Nice. Okay.
Mostly by investors.
Ooh, okay. Very on point again for what we've been discussing.
Mostly by investors, and for good reasons a lot of times. But when you look at it, imagining you're the founder, I'm not sure it's very exciting to have put your blood and sweat into something and then you're kicked out.
Yeah.
A good example is Travis Kalanick.
Okay.
Who co-founded Uber with Garrett Gump.
Okay.
And he was kicked out from being the CEO of Uber in 2017 and taken out of the board in 2019.
Wow. Okay.
Well, there were allegations of discrimination, sexual harassment. And more recently, we had the CEO of OpenAI.
Yeah. Sam Altman.
Yeah, Sam Altman. Who was outed in less than
like a week.
Exactly, it was so fast.
Yeah.
And that goes to the point that you need, as a founder, you need to find alignment with the investors.
Yeah.
And it's important to actually ensure that you're consistently aligned.
Mm.
Because sometimes as a founder, you might want to own your idea so much that you're seeking funds, but you don't want involvement of the people you're getting funds from.
Yeah. Give me your money and shut up.
Exactly. Give your money, shut up, because I'm brilliant and I'm going to see this through. It results in problems sometimes. Yeah. Or if you're going to have issues that are likely to bring problems.
Yeah.
Maybe you're basically engaged in activity that may bring problems for the investors, or actually risk bringing down, because startups tend to be very tied around their founders in terms of the personalities.
Yep.
So if you are engaged in activities that if it blows up, we may all lose our money, as investors, we're not going to take that lightly. The fact that you're outside job when you're not in the office, or even when you're in the office, you run the risk of all of us losing the money simply because you cannot behave better.
Yeah.
I mean, you might be kicked out. So I guess it's some food for thought for guys who are founders, even as you basically, for the guys who are founders, as you fundraise, and even investors, to try and ensure that there is a good alignment. Yeah, to avoid some of these outcomes.
Very interesting.
Yeah, what did you learn for the week yourself?
The Sam Altman thing is so interesting too, just the way it happened. But also, I guess, having alignment and also having people in your corner, I guess that was important for him, because there was some group of people that wanted him out. And then actually one of the investors, Microsoft, are the ones who said, we're going to take him and he's going to come to us and build like an AI shop within Microsoft. And then I guess they decided, no, he's actually going to stay and we're going to reinstate him. So I think good thing for him is he had many people in his
backing
corner.
Him, yeah.
Yeah. Even with everything that happened. But yeah, very, very interesting. He has a, the Lex Friedman podcast. He has an episode where they just talk to him about that whole ordeal.
Oh,
very interesting. People should check that out.
Yeah.
So what I learned that was interesting this week on a podcast that I listened to, that I really enjoyed, it's called My First Million. They had a guest that said something that really stuck with me, which is, when you say no, you're saying no to one thing. When you say yes, you're saying no to many things. Point being, when you say no is, he described it as a precision instrument that you use to turn down a specific thing. So you analyze, you weigh and evaluate a specific option, and you say, no, this is not for me at this point in time. You still are open to doing other things. When you say yes, you're committing time, resources, brain power, everything to that thing. And as a result, you're saying no to many other things that you might not even be thinking of. There's an opportunity cost there that I think most of the time we don't think about, right? So the point being, I guess, think about your yeses. So anytime you say yes to something, think about also the things that you're saying no to. And of course, you might not have a choice. You might have to say yes because this is the thing you need to do at that time. I need to do this job because I need the money. I need to, pursue this pursuit because it's the thing that I want to do at the moment. But think about it as you go. And every day you say yes to that thing. Keep in mind that you're saying no to other things. So is this yes still the yes that I want to be pursuing at this point? Or are there other things that I'm saying no to, even subconsciously, that I haven't thought about that I should be considering? Just within the context of your decision making and also focus, right? We talked about focus and focusing on things. If you're going to focus on something and give it all your time and effort, just make sure that it's the right thing to be focusing on. That was the interesting thing, and it really stuck with me.
Should we do this? Yeah. It's really some good lesson that you had, and I was thinking about it regarding even our podcast.
Yeah, we say yes to this every time we come. When we say yes to this,
I've actually realized that I have to put in work in terms of getting myself ready, reading up on what's happening, and I cannot afford to be out late.
Yeah.
Especially the day before we record, you know, I'm
Or
realizing
the first day when we had played golf and we were...
the first episode, but we picked lessons from it.
Yeah, we learned, which is the most important
That's a
thing.
beautiful part, we
Very,
learned
very important.
and we grow.
And yeah, I think I keep saying yes to this podcast every day because I think it's still the most effective way for me to provide value to as many people as possible in the way that I think I can. And I think the same is true for you, and we'll continue saying yes to this podcast as long as that's true.
Exactly.
So leave a comment letting us know if this is valuable to you or not. And,
yes, we'll continue saying yes to this and no to night outs. Staying out until 11, unless there's Afrobeats.
Okay.
Yeah, wonderful. So, thank you very much for tuning in and for being with us through the episode. We hope that you have enjoyed the content that we have provided, the discussions we've had. Today was largely about the funding cycles of a startup. We've gone through the bootstrapping for startups. We've equally gone through the funding from seed, pre-seed and seed financing. We've gone to post-seed. We have considered what happens around post-seed. We've also looked at Series A fundraising and the other series that follow, Series B, Series C, Series D. They could go all along, basically providing you with growth capital. And we've explained, some of the statistics that we have from Africa for last year in 2023. We hope that you found that insightful. And we've also provided you with an understanding of the people that play within the levels of investments. We have discussed friends and family, and other people closely related to friends and family. We've discussed angel investors. I mentioned to high net worth individuals, equally venture capital funds and private equity funds, as well as the differences, the key differences that you expect to find in a venture capital fund and a VC fund, and how they approach investment, and which one would be more suitable for you at the stage of fundraising. So we've also discussed insights, some insights we have taken from this conversation. Thank you very much, Adrian, for your wisdom from the course.
No
it
problem.
was pretty solid. And again, we've shared what we learned this week. So thank you very much for joining us. Please let us know your comments, your feedback. We're keen on making sure that we have a podcast that adds value to you. Let us know if you have any comments or feedback or anything that we can improve or do much better, so that we can, as we grow, that we also ensure that we're providing good content to you. So we hope that you enjoy the episode, and we're looking forward to your feedback and engagements on the same. Until next time, goodbye.
Bye. Thank you for joining us for this episode of the Full Scale Podcast. The information provided in this podcast is for educational and informational purposes only. It does not constitute legal advice or any form of advice, nor does it establish an advisor or attorney-client relationship between you, the listener, and the hosts or any guests participating in the podcast. The content shared in this podcast reflects the personal opinions and insights of the hosts and their guests, and should not be taken as a substitute for professional advice. The opinions and insights expressed by the hosts and their guests in this podcast are their own, and they do not necessarily reflect the positions of their employers, clients, or associates. The hosts of the Full Scale Podcast disclaim any liability for actions taken or not taken based on the content of this podcast. No representation is made about the quality, accuracy, completeness, or suitability of the information provided.